Hello and welcome to this week's lecture on monetary policy. We're going to examine how the Fed uses monetary policy to influence the aggregate economy. Recall from previous lectures and readings that we can describe the aggregate demand, aggregate supply model as the intersection of three different curves. The first one is the aggregate demand curve, which reflects how much people wish to purchase in goods and services at each price level. The short-run aggregate supply curve and the long-run aggregate supply curve. And in the long run, we recognize that how much an economy can produce is constrained by the factors of production, and how much we have in real resources and productivity determines the size of the economy. So in the long run aggregate supply curve tells us the size of the economy, and that's determined by real factors. In the short run, prices and output may fluctuate around this long-run trend due to nominal factors, and that's where monetary policy can possibly play a role in the economy. The first thing that we want to spend a little bit of time on is thinking about why the aggregate demand curve slopes downward. We want to review this. And the aggregate demand curve can slope downwards for three reasons that we've identified. The first one is the wealth effect. When prices fall, the real value of our bank accounts rises. If I have $100 in the bank and prices are low, my $100 goes fairly far. If I have $100 in the bank and prices are high, my $100 does not go as far. So when prices move up and down, the value of our bank balances changes in real terms. We expect that the value of our of goods and services that we buy at the store and wages and profits will move together as prices go up and down, but the real value of bank balances can change. The interest rate effect says that with lower prices, it reduces the amount of money that people need to carry in their pockets. If I want to buy the same amount of things at low prices versus high prices, at low prices I can carry less money around in my pockets and in low interest bearing checking and savings accounts, and so the less I need to carry, the more I can supply to the market for loanable funds. The more I supply to the market for loanable funds, the lower interest rates will be throughout the economy. And then lastly, the exchange rate effect. Lower prices of domestic products means that our goods and services look relatively inexpensive to consumers from abroad, and so a fall in domestic prices will lead to an increase in the amount of exports we demand.